Over the past month, Hedera HBAR has shocked many in the crypto space. The token has surged over 70% in just 30 days, at one point nearly touching a 90% rally before consolidating. These kinds of short-term gains often trigger speculation about hype-driven moves. People assume it must be another memecoin pump, a speculative exchange listing, or a random wave of capital flooding in after a sudden announcement. But in Hedera's case, that assumption couldn't be further from the truth. Unlike low-cap coins that explode purely on narrative, Hedera is a top 20 cryptocurrency by market capitalization, already established as a long-term player in the industry. Its recent growth is not a flash-in-the-pan phenomenon. It's rooted in three clear drivers: the growth of stablecoins on the Hedera network, expanding retail access via major platforms, increasing institutional adoption and experimentation with tokenization. To really understand why Hedera's run has been so strong, and why this may just be the beginning, we need to look at the foundation it has been building for years. And that foundation starts with stablecoins. Why stablecoin growth matters. Stablecoins are the lifeblood of the modern crypto economy. They account for the majority of daily transaction volume in digital assets, serve as the bridge between traditional finance and blockchain, and provide a neutral currency that investors, traders, and businesses can rely on without volatility. In fact, stablecoins like USDC and USDT now rival some of the world's largest banks in terms of money movement across borders. For Hedera, capturing this market has been crucial. The platform has seen a 146% month-over-month increase in stablecoin activity, even before the recent passage of the U.S. Genius Act, a piece of legislation that further boosted regulatory clarity for dollar-backed digital assets. Since the Act's passing, Hedera has seen another 14% growth in just 1 week, pushing its native USDC holdings to over $212 million. This figure may seem small compared to Ethereum or Tron, two blockchains that dominate stablecoin circulation, but the growth rate is what makes Hedera stand out. It is rising faster than almost any competitor, showing that institutions and developers are beginning to favor its architecture for real-world use cases. Stablecoin Studio, the key growth engine. At the heart of Hedera's adoption story is its Stablecoin Studio, a suite of tools designed to make issuing and managing stablecoins straightforward for banks, fintech companies, and enterprises. Think about the challenges of stablecoin adoption: compliance with regulatory frameworks, proof of reserves to ensure backing, treasury management tools for issuers, efficient token minting and burning, cost-effective transaction infrastructure. Stablecoin Studio solves all of these in one package. It's not just about creating a token. It's about giving financial institutions the compliance-first infrastructure they require. For example, proof of reserves integration makes it easier to provide transparency, while low fees, fractions of a cent per transaction, make Hedera more efficient than many of its competitors. Add to that Hedera's unique Hashgraph consensus mechanism, which provides extremely high throughput, thousands of transactions per second, and near-instant settlement finality, and you begin to see why institutions are leaning toward it. Unlike traditional blockchains that face bottlenecks and congestion, Hashgraph's structure is built for speed and scalability. This combination of speed, compliance, and cost efficiency is what positions Hedera differently from other Layer 1 platforms. It isn't chasing hype. It's quietly building the rails for large-scale financial adoption. Regulation and timing. Timing has also played a massive role in Hedera's recent momentum. The passage of the Genius Act in the United States was a watershed moment for stablecoins. For years, regulators were hesitant to provide clear guidelines, which made institutions reluctant to fully embrace the technology. Now, with favorable laws on the books, banks and fintech companies are eager to enter the market. Stablecoin Studio arrives at exactly the right moment. As soon as the green light was given, institutions needed a compliant infrastructure partner. Hedera is positioning itself as that partner, making it the on-ramp for institutional stablecoin issuance. But it's not just about compliance in the U.S. Other regions are also developing regulatory frameworks, and Hedera's architecture makes it adaptable across jurisdictions. The combination of U.S. regulatory clarity and Hedera's ready-to-deploy toolset is what has fueled the recent explosion in activity. Why this matters for investors. For retail investors watching Hedera's rally, the big question is this just a short-term pump? Or is it the start of something larger? The answer lies in the nature of the adoption. When a token rallies because of speculative hype, it usually crashes just as fast. But when adoption is driven by fundamental use cases like stablecoins, real-world assets, and institutional partnerships, the growth tends to be more sustainable. Hedera's recent numbers reflect real, organic demand. Institutions are experimenting with tokenization. Stablecoin volume is increasing rapidly. Regulatory clarity has arrived at the perfect time. This makes Hedera less of a speculative bet and more of a long-term infrastructure play. If you believe that stablecoins will become the backbone of global finance, and there's a strong case for that, then Hedera is positioning itself as one of the networks best suited to handle that demand. One of the most important drivers of crypto adoption is accessibility. No matter how strong the fundamentals of a project are, if everyday investors don't have an easy way to buy and trade it, adoption will lag. For years, this was one of Hedera's biggest challenges. Despite its strong governance council and enterprise partnerships, it wasn't as widely available to retail investors compared to some of its peers. That began to change when Hedera HBAR was listed on Robinhood, one of the most widely used trading apps in the United States. While Robinhood is often criticized for catering to casual investors, its impact on crypto adoption can't be overstated. Millions of Americans use Robinhood as their entry point into investing, not just for stocks but for digital assets. The addition of HBAR on Robinhood instantly expanded its reach to a demographic that values ease of use, low fees, and mobile-first investing. Within days of the listing, BAR's price climbed from around 24 cents to 27 cents, even as the broader crypto market remained flat or declined. This showed clear evidence of retail demand. People were waiting for an accessible way to gain exposure, and once that barrier was removed, they acted. Retail adoption may seem small compared to institutional partnerships, but it plays a crucial role in creating liquidity and community strength. Every bull run in crypto history has been fueled in part by retail excitement, and Robinhood's integration ensures that Hedera now has a growing base of grassroots investors. The influence of public figures, Kevin O'Leary and beyond. Beyond platforms like Robinhood, another catalyst for retail adoption is social proof from influential figures. Kevin O'Leary, known as Mr. Wonderful from the show Shark Tank, has publicly spoken about his bullish outlook on Hedera. While O'Leary has investments across multiple crypto assets, he singled out HBAR as one of the most underrated projects in the space. This kind of endorsement matters for several reasons. Visibility: millions of mainstream viewers recognize O'Leary, and when he talks about Hedera, it introduces the project to people who may have never heard of it. Credibility: whether you agree with his views or not, O'Leary is known as a savvy investor. His stamp of approval carries weight, especially with audiences outside the crypto-native community. Momentum: public endorsements often create a feedback loop. As more investors hear about Hedera from credible figures, they begin researching, buying, and holding, which drives price and adoption further. Crypto history is filled with examples of personalities driving waves of adoption, from Elon Musk tweeting about Dogecoin to Jack Dorsey championing Bitcoin. While Hedera isn't reliant on celebrity hype, having respected investors like O'Leary in its corner adds an extra layer of visibility. Institutional adoption: a different level of growth. While retail access is important, the real story of Hedera's long-term potential lies in institutional adoption. Retail investors bring liquidity and community enthusiasm, but institutions bring deep pockets, real-world use cases, and long-term commitments. Earlier this year, Hedera achieved a major milestone: the first tokenized foreign exchange, forex, trade in the United Kingdom. Aberdeen Investments and Lloyds Bank, two major financial players, used tokenized GBP as collateral for a forex trade conducted on the Hedera network. This was not just a symbolic experiment. Forex is the largest financial market in the world, with daily volumes exceeding $7 trillion. Even a tiny fraction of that market moving onto blockchain rails would represent massive growth. Hedera's ability to host such a trade demonstrates its technical capacity, compliance readiness, and appeal to serious institutions. The significance of this trade cannot be overstated. It sets a precedent for other banks, asset managers, and financial institutions to follow. Once one major player tests tokenization on Hedera, competitors are incentivized to explore similar moves to avoid being left behind. The ETF pipeline, Grayscale, Canary, and beyond. Institutional interest isn't limited to tokenized trades. In parallel, there has been a surge of applications for exchange-traded funds, ETFs, connected to Hedera and other altcoins. While Bitcoin and Ethereum ETFs have dominated headlines, the expansion into staking ETFs and tokenization-focused funds shows that demand is broadening. For example, Switzerland recently saw the launch of its first staking ETF, which allows investors to not only gain exposure to price appreciation but also earn staking rewards from assets like HBAR. This innovation is crucial because it bridges the gap between traditional financial products and decentralized finance, DeFi. On top of that, firms like Grayscale and Canary have already submitted ETF applications that include Hedera. While approvals are not guaranteed, the momentum is undeniable. In fact, many analysts are giving upwards of a 90% chance that some of these products will be approved in 2025, unlocking another wave of institutional capital. ETFs are powerful because they make investing in crypto assets as simple as buying a stock. Pension funds, retirement accounts, and large asset managers that are restricted from directly buying tokens can easily access them through ETFs. If Hedera becomes part of that pipeline, the influx of capital could be transformative. The convergence of retail and institutional growth. What makes Hedera's current moment unique is the convergence of retail and institutional adoption. Historically, crypto assets have seen one or the other dominate at different times. Bitcoin's early growth, for example, was retail-driven. Ethereum's adoption, particularly in 2020 to 2021, was largely retail as well, with DeFi and NFTs fueling the frenzy. Institutional interest came later. Hedera, however, is benefiting from both at the same time. On one hand, Robinhood listings and celebrity endorsements are expanding retail participation. On the other, tokenized forex trades and ETF applications are laying the groundwork for institutional flows. This dual momentum creates a reinforcing cycle. Retail adoption provides liquidity and awareness. Institutional adoption validates the technology and creates long-term use cases. Together, they sustain growth in both market capitalization and real-world utility. When you zoom out and take in the bigger picture of what we've been discussing, it's hard not to see Hedera as one of the most strategically positioned projects in the entire digital asset space. The last 30 days of price action, up over 70% despite recent pullbacks, are not a random pump or a fleeting speculative rally. They represent the culmination of multiple structural trends converging at once. Regulatory clarity, surging demand for stablecoins, institutional pilots that prove real-world viability, and increasing retail access through mainstream platforms. These are not surface-level signals. They are foundational markers that point to where this industry is going and who is best prepared to thrive in it. Hedera sits near the top of that list. Think about adoption in layers. On the surface, retail access plays a huge role. The Robinhood listing, whether people love or hate the platform, put HBAR in front of millions of casual investors. Every time Hedera makes itself more accessible, it's building a bridge for retail participation. And retail matters because, over time, retail enthusiasm creates liquidity, awareness, and grassroots support. This is the same dynamic that carried early projects like Ethereum and Cardano into mainstream consciousness, even before the biggest institutions came knocking. The fact that Hedera is experiencing that same surge of retail visibility, while simultaneously appealing to large institutional players, is a testament to how carefully it has been positioned. But beyond retail, the real story lies in Hedera's institutional pull. Aberdeen Investments and Lloyds Bank executing a tokenized foreign exchange trade on Hedera may seem like a small footnote at first glance. In reality, it's a landmark moment. This is not a test transaction on some obscure testnet. This is a heavyweight asset manager and a legacy financial institution experimenting with real tokenized collateral. That's historic. Tokenized FX is not just a gimmick. It's an indicator of how trillion-dollar markets might start to transition to distributed ledger infrastructure. When these experiments succeed, they set precedents. Other banks and investment houses will follow. What starts as a small pilot trade can quickly snowball into a full-fledged network of high-volume financial activity. That's why the conversation about ETFs and structured financial products tied to Hedera is not out of reach. As we've seen with Bitcoin and Ethereum, institutional-grade investment vehicles change the game. They open the door for pension funds, insurance companies, and traditional asset managers to allocate capital into an asset they previously considered too volatile or inaccessible. Already, we've witnessed the first staking ETF launch in Switzerland, giving investors both yield and exposure. If Hedera can ride that same wave of structured product innovation, the influx of institutional money could redefine its market profile overnight. The stablecoin narrative is perhaps the most important of all. Stablecoins are the beating heart of the crypto economy. They facilitate nearly every transaction, they power DeFi, and increasingly, they serve as rails for real-world payments. Hedera's meteoric growth in stablecoin adoption, 146% month-over-month at one point, even before the favorable Genius Act legislation, signals that enterprises and issuers recognize its unique value proposition. It's not just speed or cost, although both are stellar. It's the Hashgraph architecture that makes it possible to settle thousands of transactions per second with finality, and it's the regulatory-first design that makes institutional actors comfortable. The Stablecoin Studio is a direct answer to what banks, fintechs, and corporations have been quietly asking for: a compliant, efficient, customizable toolkit for stablecoin issuance. That's how Hedera moves from being just another altcoin to becoming infrastructure that underpins new financial systems. Layered on top of stablecoins is the growing conversation about real-world assets, or RWAs. This is where things get truly exciting. Tokenizing real estate, bonds, commodities, and equities isn't just a buzzword. It's the future of capital markets. The World Economic Forum and multiple consultancies have already published forecasts suggesting trillions of dollars in assets could move on-chain over the next decade. Hedera is uniquely suited to capture this flow because of its compliance features, its enterprise partnerships, and its ability to deliver secure, scalable performance. RWAs will not succeed on platforms that can't handle throughput or regulatory scrutiny. Hedera passes both tests with flying colors. Even the AI angle deserves more recognition. Artificial intelligence is becoming deeply intertwined with blockchain as companies look for ways to verify datasets, track model training, and secure intellectual property. Hedera's architecture makes it well-suited for these integrations, and the project's openness to innovation positions it as a fertile ground for AI blockchain hybrid applications. The narrative of crypto plus AI is often overhyped, but in Hedera's case, it aligns naturally with its mission of trust, transparency, and verifiable data. Tokenomics are another key factor that should not be overlooked. A strong rally is only sustainable if the supply dynamics allow it to be. Hedera's controlled release schedule, its treasury management, and its Enterprise Governance Council all contribute to a more stable economic model compared to the chaos of many meme-driven or unstructured projects. That doesn't make Hedera immune to volatility, it's still crypto, but it does mean that the growth we're witnessing has sturdier legs. It's not just hype inflating the balloon. It's usage, utility, and capital inflows. Stepping back, the macro environment is lining up in Hedera's favor. The regulatory climate in the United States, once hostile and uncertain, is now showing signs of clarity. The Genius Act, the Clarity Act, and other policies are shaping a framework where compliant, enterprise-ready blockchains can thrive. Projects that ignored compliance or took shortcuts may find themselves squeezed out, but Hedera's foresight in prioritizing transparency and legal compatibility gives it a clear runway. At the same time, global momentum is accelerating. From Switzerland's ETF launch to the UK's tokenized trade, Hedera is becoming a recognized player in major financial hubs around the world. All of this makes the recent surge in price less of a random spike and more of a logical response to fundamentals. Yes, 70% in 30 days is dramatic. But when you dissect the catalysts, regulatory wins, retail adoption, institutional pilots, and technical readiness, it feels like a natural repricing of an undervalued asset. And if these trends continue, this may be just the beginning. We're not talking about a pump and dump. We're talking about the early innings of a long-term revaluation. Of course, no project is immune to risks. Market cycles can still bring volatility. Regulations can shift. Competition from other networks is fierce, whether from Ethereum, Solana, or newer players. But when you weigh the risk against the momentum Hedera is building, the case for optimism becomes compelling. This is not a speculative dart throw. It's a project with tangible adoption, institutional credibility, and a growing ecosystem. So where does that leave us? It leaves us with a blockchain, more accurately a distributed ledger, standing at the crossroads of retail enthusiasm and institutional validation. Hedera is not chasing hype. It's securing real deals, solving real problems, and laying the groundwork for long-term growth. And in crypto, that combination is rare. Too many projects rely solely on community hype or speculative narratives. Hedera is marrying that community energy with institutional substance, creating a feedback loop that can sustain momentum through the inevitable ups and downs of the market. As investors, builders, or even curious onlookers, the question we must ask is not just whether Hedera can pump in the short term. The real question is, can Hedera become indispensable infrastructure in the emerging digital economy? Based on everything we've examined, stablecoins, RWAs, AI integration, retail access, institutional partnerships, the answer increasingly looks like yes. This isn't just about being a top 20 token. It's about being part of the backbone of the next era of finance and technology. And if that's the direction things are moving, then what we've seen so far, the 70% gains, the 90% spike, the flurry of attention, is not the end of the story. It's the prologue. The real chapters are still to come. Hedera has the tools, the partners, and the timing to not only participate in this transformation but to help lead it. And that, more than any short-term chart movement, is the signal worth paying attention to.